I'm going to start the recording. Today's discussion is going to be on equity management. We're going to be discussing equity management here together before we start on our road toward understanding the appropriate technical aspects to be able to trade the upcoming non-farm payrolls announcement. So we're going to start by talking about equity management. When it comes to equity management is going to be the art of capital preservation. We can't really control too many things in this market. Actually, we can't control any. The only one that we can control is how much we're going to put at risk. So I want to make sure that we are keeping track of that, protecting what we already have. There's a big difference between when successful people do things and when unsuccessful people do things, and it's usually in the way that they set about doing it. When it comes to successful people will take the time to educate themselves before they act, whereas unsuccessful people will not. Just jump right into it. Don't take time to factor the cost. Don't take time to educate themselves and learn about the potential pitfalls that may occur whenever they're getting ready to enter into their whatever their new venture is. All right, and we want to make sure that we are fully aware of these things when we decide to get involved. When it comes to our investment decisions as successful traders in the making, our primary focus needs to be the preservation of the capital that we already have. All right? Again, we do not know how much we will ever gain in this market. We don't know that from the onset. Trading is not for everyone. But what we do know is what we're getting ready to get started with, what we're getting ready to put on the line. So you need to make sure that you are taking the steps to protect what you already have. Cannot impress it upon you enough. Our secondary focus, believe it or not, is going to be the tax consequences of our trading. So we're not going to be immediately capturing profit and spending all of it. We need to make sure that we are rendering unto Caesar what's due to Caesar. If you live in a country where you are required to pay taxes on any gains that you capture in the markets, make sure that you are making that separation. If you're making any withdrawal, you should be withdrawing what you need to pay Uncle Sam, for example. If you're in the U.S., you need to make sure you pull that money out first, set it aside so that you don't get ahead of yourself overspending, and then when the IRS comes knocking on your door, or one of your tax services, depending on where you are, they come knocking on your door saying, hey, seems like you owe us a tiny sum here. You're not caught with the proverbial pants down. All right, so keep that in mind. Our final focus as successful traders in the making is going to be the return on investment, right? In that order, right? Usually when a trader starts to think about trading, the first thing that they're thinking about is, oh, they're building castles in the sky, how wealthy and successful they're going to become. We need to become more realistic. We need to set that to the back burner. It's very likely fortunes are made every day on this market, but you need to be realistic about it. This is not a get-rich-quick scheme. It's going to take time to build to that. You have to have a stout plan in mind. All right? And that's what we're going to be working on with these lessons. So, again, we're well aware. You may never quantify how much you're going to be able to make on a trade, but you can quantify how much you're going to put on the line. So make sure that you are managing the risk. As a successful trader in the making, you want to make sure that you are always trading with a protective stop loss order. We never, ever, ever trade without a stop loss. All right, we put that in as soon as we decide to buy or sell the market. We immediately put in a stop loss price so that we know how much is going to be on the line, maximum. And the maximum amount or the maximum percentage that we put on the line is never to exceed 2 to 5% of our margin account on a single trade. As a matter of fact, I would spread that to include if you're in multiple trades, we're not going to put more than 5% of our total account at risk. All right? That would be the wisest course of action. When it comes to money managers are trading accounts for other people or other entities. So big companies may have traders on staff that are just simply there to trade for the company. And so these individuals will look to risk no more than 2% on any given trade. Their risks are very, very, very conservative. Granted, they more than likely have a significantly larger account size than most typical people that get started, most speculative traders. But those are not their funds, so they have to be extra careful with it. So as a result, speculative traders like ourselves tend to take on slightly higher risk, between 2 to 5%, but we're still talking about a very minuscule portion of our overall account balance. All right? We need to trade as if the worst is going to happen. Right? If we were to take a series of losses, would we be able to financially survive in that situation? So in order to more appropriately come to terms with equity management, we first and foremost have to understand how a margin account works. Okay? When you go to open up an account, it's just like opening up any other bank account, right? Except you're likely not going to a physical location. Most Forex transactions take place in the internet or on the internet. So when it comes to your margin account, you are going to log on to one of these brokers' websites, right? Since we have to place our trades through the broker, you would log into one of their websites, whichever broker you prefer. If you've done your research, asking different traders about their experiences with their brokers, or maybe you've done financial comparisons with the brokers, or you've looked up their histories, whatever the case may be. Hopefully you've done your research and you've chosen your broker, right? It's not a super difficult thing to do. Once you've chosen your broker, you go ahead and you log on to their website, you open up an account, right? Now, when you decide to place a trade on the market, a lot of traders think that the more they bring to the market starting with, the more they'll be able to do. And to an extent, that's true, but it's not for the reason that they think it is. Because you're not actually taking whatever amount you bring to the market and going to physically trade that sum. Right? Instead, your margin account works where you can take a small amount of money and trade to go make more than you're actually putting on the line. It's operated on margin. The way that it works is you are essentially taking a short-term loan from the broker, right? Where you are taking the broker's money to the Forex market. You are trading that money, and since technically it's not your money, you're being paid a percentage per pip that you capture. Right? You're being paid a percentage per pip that you capture. Okay? So this is operated by your broker. The accounts are placed, the trades are placed by your broker. You determine where you're going to get in, right? That's why we look at the charts. You determine where you're going to get in, where you're going to get out. But when you click on buy or sell, your broker is the one that's actually physically putting the trades into the market for you. Right? And as you trade, you capture profit or lose profit. You will capture or lose funds as that goes along. Right? Which is why we always put in the protective stop loss to make sure that we don't put more on the line than we should. Okay? Any questions on this before we continue? Okay, so now with respect to those short-term loans that we're taking, those loans are also taken on leverage. Right? We're going to discuss that in a minute, but you'll have leverage ratios like 100 to 1, 50 to 1. The United States has some of the lowest. I'll never get used to that. The United States has some of the lowest leverages that there are because the government feels that it needs to protect us from ourselves. So due to the nanny state legislation, the United States leverages are capped at 50 to 1. right? But you can go overseas or have overseas accounts, or you can get significantly higher leverage amounts. When it comes to opening up the account, what happens is, again, as I mentioned, it's just like opening up an account at a bank, except more than likely you're doing it online. So you fill out the appropriate information, and then once you fill out the appropriate information, you would make a deposit, right? So for this example, the deposit amount is going to be 10,000 US. So they will take your $10,000 and they'll open up an account, and now you have an account, a margin account with $10,000 in it. But if I decided that I wanted to go trade on the Forex, I'm not going to grab my $10,000 and go trade to the market, right? I'm not going to grab all of my money and just go straight to the market with it. When I go to place a trade, I will take a small loan from the broker and go trade their funds. Now, when I go to do that, I have several options when it comes to lot sizes. And the options are the following. Your three basic lot sizes, and there are some in between, right? But these are the three basic lot sizes. Your three basic lot sizes are the 1K lot, that's called a micro lot. It's a $1,000 position. So if I decide that I want to trade a micro lot, I go ahead and I tell the broker, look, I want to get in at this price, and when I select my lot size of 1K, I tell the broker I want $1,000. Give me $1,000. I'm going to go trade this on the Forex market. And as I trade, for every pip that I capture, the broker is going to pay me at 10 cents per pip, 10 US cents per pip. Every pip that I capture and or lose, when we're talking about micro lots, we're talking at a rate of 10 cents per pip on average. Next, you've got the mini lot. The mini lot is a 10K position, or a $10,000 position. So instead of taking my $10,000 and going straight to the market, I would take the broker's $10,000 and I would look to be paid at $1 per pip on average. And last but not least, you've got the one that everyone falls in love with. That's the ultimate goal for most new traders, to be able to trade with a standard lot. Right? Trading at a standard lot, you're trading $100,000 of the broker's funds at a time, and that's going to be equal to a payment of $10 per pip that the market moves. Right? Every time the market moves 1 pip in your direction, $10. If the market moves 1 pip against you, it's $10. Right? Any questions on these basic lot sizes? Okay. So let's say we've got a trading scenario where you've opened up your account, right? And you've placed your $10,000 in your account. And then you get on the markets, you start looking at charts, and you find a chart where you have an opportunity to buy. You examine the uptrend, you put on your A, B, C, Ds, you see the market come down to a deep C, and at a deep C gives you a bullish candlestick formation. Who knows, maybe even a counter trend line break, stochastic U-turn in your favor. You see that this is the opportunity for you to be able to buy the market. So you decide that you are going to enter into your first trade. You want to buy. And when you decide you're going to buy, you're going to get in with one mini lot and a spread of 3 pips. Now, when we're talking about a mini lot, what kind of position size are we talking about? How much are we being paid with a mini lot? Exactly. We're talking about a $1,000. No, we're not. We're talking about a $10,000 position, right? So with a mini lot, I'm looking to take a $10,000 short-term loan from the broker and I want to look to go trade that on the market. So that means I'm going to be looking to be paid at $1 per pip. Now, when it comes to the spread is the difference between the bid and the ask price. When you take a look at a chart, most times on most charting platforms, you are actually looking at bid charts. I know for sure the MTI charts are bid charts, right? But your broker is monitoring two different charts. They are monitoring both the bid and the ask prices, right? They're not looking at, for example, if it's a US dollar, Japanese yen, they're not looking at a dollar chart and a yen chart. They're looking at the US dollar, Japanese yen bid price, and they're looking at the US dollar, Japanese yen ask price. You sell at the bid, you buy at the ask, right? So they're monitoring both these charts, and there's usually a slight difference between the two. The difference is usually between 3 to 5 pips, and it's that difference in price that the broker charges us as traders to be able to place the position. That's your spread, right? So if we're trading with a mini lot, once again, we're trading in terms of $1 per pip, which means that if we have a spread of 3 pips, that means the broker wants to charge us to place this position $3. In order to place this position, we have to pay $3 to the broker, right? So if we are trading with a U.S. broker, right, we're going worst case scenario in this example. So if you're trading with a U.S. broker, you've got puny leverage of 50 to 1. Right, puny leverage of 50 to 1. So the broker is going to ask you, your leverage means what your margin requirement is going to be. Right, your down payment. Your margin requirement is your down payment. When it comes to any kind of business purchase, right? Let's say you're going to buy a car. Most people cannot simply go and buy a car cash. So usually what they do is they finance the car. And when they go to finance, or the house, or whatever the case may be, when they go to make this finance, they sit down with the bank and they fill out the information, and the bank says, okay, you're approved. Now we need you to put down this much down payment. Skin in the game. The bank wants to know that you are also invested in this business transaction that you're about to get into. So they'll require the down payment, whatever the case may be, right? Your margin requirement is going to be the same thing. Your down payment that you're putting down towards this short-term loan that you're taking, except that your margin requirement is refundable, right? And we'll talk about that later. But your broker, based on the leverage ratio, will tell you how much they require that you put down. So whatever lot size you're planning on trading, you have to at least have, in this case, 50 to 1 leverage. 2% of that, they will require that you pay 2% up front as a down payment. Any questions on that? Because what's happening is, if I decide that I want to place this position, I want to get into the market, buying the market with a mini lot, I'm telling the broker that I want to trade $10,000 of the broker's money. So if I have to give them a margin requirement of 2%, 2% of $10,000 is $200 as security. That's my deposit or my down payment that the broker is going to hold until the trade is closed at a profit, or until a margin call has been made. A margin call is when the broker decides you don't have enough money in your account to continue that trade. So they'll close you out. Even though your stop loss hasn't been hit, they will close you out at a loss. Right? So make sure that doesn't ever happen. You don't ever want to trade with the bare minimum, the bare margin requirement in your account, because you will be stopped out at a loss. So again, that $200 figure that we were talking about is based on the leverage. So whatever your leverage is, whatever your margin requirement or your margin ratio is, In this case, we talked about the ratio being 50 to 1, a U.S. account. The leverage is 50 to 1. You can calculate your percentage by that. In this case, it would be 2%. So if you take 2% of $10,000, that is $200 as a margin requirement. So when I decide that I want to go place this trade, that margin requirement, down payment, is going to be withdrawn from my account, as well as the spread. The margin requirement is withdrawn from your account as soon as you decide to execute the trade, as well as the spread. So in my particular case, right here, right now, with the $10,000 that I have in my account, as soon as they pull out the $200 margin requirement and the spread of $3, they've pulled out a total of $203 from my account. Excuse me. They've pulled out a total of $3 from my account, so my margin account now reads $9,797. Okay, that's what I have left in my account now. So we'll fast forward in time a little bit, assuming that I was able to capture some profit in the market. I captured 50 pips. If I captured 50 pips and I was trading a mini lot, that means that I've been being paid at $1 per pip. So if I captured 50 pips, I captured a total of 50 US dollars. But since when I got started with the position, I had to pay the broker 3 pips, or 3 US dollars in this case, I effectively started at a loss, right? Because they're taking money from me before I've even had a chance to make any. So I started effectively at a loss of 3 pips. Now that I've captured 50 pips after the fact, I have a net profit if I subtract those 3 pips that I initially lost to the broker. If I subtract that, I have a net profit of 47 pips. I also get that margin requirement that was held as security returned to my account. So $247 now get returned to my account, which means that my total account balance now reads $10,047. Right? Any questions on that? Now, if I decided that I wanted to trade this, most traders, again, as I mentioned, a lot of traders' goals, immediate goals, traders tend to fall in love with the Forex when they hear about the standard lot, right? And yes, it's very fanciful to want to trade and be paid at 10 US dollars per pip and be able to make lots and lots and lots of money with very little market movement. Okay, it's a fantastic thing. With that said, it's not something that everyone can do from the get-go. So you have to make sure that you are keeping this in mind. If a group of 5 traders are all taking a look at the same position, not everyone has the same financial circumstance. So let's put this into perspective. We've got, let's say I've got $1,000 in my account. That's all I have. I've got $1,000 in my account, and some of my friends are also looking. We've been talking about this position. We've been talking about this opportunity for a while now, and the market is finally setting up. Now, my other friend has $2,500 in his account. My other friend has $5,000 in her account. The next person has $10,000, and the last person has $15,000 in their account. They're all way more well off than I am, right? So I've got a humble little account, $1,000 in my account. Could have less. Let's say $250 in my account, whatever the case may be. I've got a humble account, but we're all looking at the same position, right? And we all are in love with the ideal of being able to trade the standard lot and make $10 per pip. Now, in order to take this position, we want to make sure that we're giving the market room to breathe. So we're placing our stop loss below the nearest level of support, or below the A. And that stop loss total is going to have or include a risk of 50 pips, right? My total risk, if I want to kind of give the market a little bit of room to breathe, test the low if it needs to, it's going to be a risk of 50 pips. If we're all considering trading this position, That means that 50 pips times $10 a pip, which is what the standard lot pays. That means that we're all looking at a risk of about 500 US dollars. Now herein lies the issue. Based on the account size, these different traders, myself included, are looking at a vastly different situation. For me, this is potentially a financially ruinous decision to make, because if I decide to enter into this trade, trading a standard lot with a $500 risk, and my total account size is $1,000, and that means I'm putting half of my account at risk for this one trade, which means I can only be wrong one time. My other friends, the friend with $2,500, he's taking a 20% risk on one trade. Friend with $5,000 in their account taking a 10% risk. It's only my very, very well-off financial friends. They've got this $10,000 play around Forex account. You know, my other friend's got a $15,000, you know, account that he just dabbles in for Forex. He's very well off, right? They now have, they're taking 5% and 3% risks respectively, right? But they're the only people in this entire group that are within the scope of appropriate equity management, trading at a standard lot. They're the only people that can comfortably do that. The reason for that is the amount of losses that I can endure. If this trade were to go wrong, it's not really going to affect them like it's going to affect me. A $500 loss is merely a very, very small percentage of their total account balance, whereas for me, it would effectively obliterate my account. So I can't go around trading like this. We have to make sure that we are taking risks that are appropriate for us as traders. Does it mean that I can't participate in that position? Absolutely not. But I have to seriously reassess my lot size and trade with something that's more appropriate for my account as it is right now. Okay, so instead of going off the deep end here from the get-go with a standard lot, I might reconsider and look at maybe a mini lot or a micro lot. If all of us all of a sudden decided to trade the same position with a micro lot or a mini lot instead, for example, if we're trading with a mini lot, we're trading once again in terms of $1 per pip. So the same position, same currency pair, same time frame, same risk of 50 pips is now reduced by a factor of 10. The total value is now reduced by a factor of 10. That same 50 pip risk is now, with a mini lot, a total of $50 in risk. $50, that's it. So now with a $50 risk, me with my $1,000 account, now I am comfortably within the realm of equity management. I am right at my maximum threshold for risk. I'm now looking at a 5% risk. I can take this trade. And my other friends, of course, are significantly more comfortable. So my friend that has $2,500 in his account, he can take this position only risking 2% of his account. My other friend with $5,000 in her account, she's only taking a 1% risk, and so on, 0.5%, 1/3% risk. This is what it's about, the ability to be wrong. Not that we want to take losses, right? We absolutely don't want to do that. No one enjoys losing. But when we are trading, we cannot tell the market what to do. We are going to take losses. If there's any guarantee in this market, it's that you're going to take a loss at some point. So you might as well prepare for it now. If you're going to take a loss, then you have to make your wins count. We don't know when those wins are going to occur. We're going to prepare for them as much as possible and trade to win every time. But that doesn't guarantee it's going to happen. We will be taking losses along the way. So we want to make sure that we're trading with the ability to financially survive the inevitable losses that we're going to take. And if I trade this position with that risk, with this lot size, I have the ability to be wrong 20 times in a row. I doubt that that's going to happen to anyone here. But I have the ability to take the same position and be wrong about it 20 times in a row before I completely obliterate my account. The reality is that that's not going to happen. It's going to be, here's how it actually gets better, right? If I were to be wrong, let's say that I take this position and I am wrong, and I lose $50 in my account. If I lose $50 out of my account, then now my total account balance drops down to 950 US dollars. So now my total account balance is less, which means that if I decided to take a position and I'm risking 5% of my account, that total account size is now less than I had before, which means that the risk that I'm getting ready to take next is less than the risk that I took last time. Does that make sense? Because my account balance has diminished and I'm not looking to put more than 5% at risk at max. I'm taking a smaller risk in general. All right? So again, we are trading with financial survivability in mind. When it comes to placing trades, follow the acronym. Keep it simple, students. Keep it simple. Lots of traders get all bent out of shape when they start to learn this. They feel that they have to point out absolutely everything and use every single indicator in the book. And I've worked with traders that have had that issue. I've received emails, traders, I have no idea. They say, I have no idea what I'm looking at. This doesn't make any sense whatsoever. I'm completely flabbergasted by this market. I have no idea what to do. Okay, well, let's take a look at it together. Show me your currency pair. And when I look at the chart, they've got, I've worked with one trader that had well over 25 indicators on one chart. And it wasn't a system. It was just, I've got all these indicators on the chart. All right, well, tell me about the indicators. What do you use? Because some traders can, and do use indicators effectively. Tell me about the indicators. What is it that you're looking to achieve with the indicators? There was a significant percentage that I have no idea. I just put it on there because I saw someone using it. So let's be realistic about this. If it does you no good, right? If you don't know what it is and it's doing you no good, get rid of it, right? There's no need for it. We want to, as the FX chief would say, eliminate the unnecessary and only allow the necessary to speak. So don't give yourself analysis paralysis. Don't try to do everything. Don't try to trade every single technique that you learn inside the Ultimate Traders package or continuing education for that matter. Don't try to mix them, right? Don't try to mix them. First and foremost, we'll keep it local to the Ultimate Traders package. The Ultimate Traders package was designed with different trading types in mind, right? Because not all traders are going to jive with the same frequency. There are some traders that look at the market, they look at a small time frame, and they cannot fathom how traders sit in front of their computer for hour after hour after hour looking for these teeny tiny little positions, and it just, oh man, that just seems like so much work for so small amount of reward. It doesn't make any sense. I can't do that. I can't bring myself to do that, right? Whereas the scalp type trader, right? They look at scalp type traders doing their thing. But the scalp type trader, on the other hand, will look at a position trader and will say, are you kidding me? I can, in the time that it takes you to take one position, you're in this position for a week, 2 weeks, a month, and you only captured this amount of pips. I got into 400 positions and I captured 3 times as much, right? So it's really a matter of perspective. What you find, because scalp type traders may find, they typically find that more exciting than just setting it and forgetting it. So scalp type traders tend to be a little bit of adrenaline junkies, if you will. Naturally, we don't want to let that particular addiction overwhelm our equity management ever, right? Following the rules of equity management, you can trade whatever you want. But every type of trading, each style of trading is not going to suit you. So you have to make a decision as a trader as far as what style suits you best and look to trade that way. You're going to find many lessons in the Ultimate Traders package that you will feel were custom designed for you. And you're going to find a couple of them that you're just like, what the hell happened here? What? I think the chief needs to put the scotch bottle away. What's going on with this, right? You're not going to understand the reasoning behind it, and that's okay. It just means that that trading style, that strategy does not align with your personality, and it has to in order for you to be effective with it. So you're going to, as you go through the education, focus in on 1 or 2 trading techniques that you understand and that you feel comfortable with. Only look to trade patterns that you can easily identify. There are 3 main types of candlestick formations, for example, that the Ultimate Traders Package teaches us, right? We know we've got the tweezer tops, tweezer bottoms, engulfing bullish, engulfing bearish candlestick formations, and we've got the morning and evening star formations. Those are the easiest, most consistent candlestick formations that exist, right? If I don't know what a piercing line is, if I don't know what a shooting star is, then I'm not just going to jump into the position, right? If someone says, oh yeah, take a look at this thing where a shooting star is taking place, yada yada. If I don't know what that is, I'm not just because X and Y trader is saying, yeah, I'm getting in at this candlestick, I'm not just going to jump in because I have no idea what they're talking about. That doesn't make any sense. That is blindly following, blindly jumping into a position. It defeats the entire purpose of becoming educated on what the market is doing. So use proper judgment. Make an accurate assessment of the upcoming opportunity, if you will. Make an assessment of the opportunity on your own and then make an educated decision as far as whether or not it's right for you. Don't take on the burden or the guilt, for that matter, of learning everything. It's just a lot of information to take in. This is a self-paced education. It's a self-paced education. So don't take on the burden of trying to absorb everything at one point in time. Take it at the pace that's appropriate for you. Again, do only what is comfortable for you. Do not try to exceed your skill level when it comes to trading, right? And only you can determine what that is. If you want to compare notes with the analysts, send us your analysis or whatever the case may be. By all means, you can do that. Hey, look, listen, I'm taking a look at this currency. Here's what I have so far. I think it's going to do this, right? And we will be more than happy to go through that with you. We cannot tell you when to get in or when to get out, right? But we can absolutely take a look at it and evaluate the accuracy of your analysis based on the education of the Ultimate Traders Package. Not a problem. When it comes to your trading, you want to learn to trade so that it becomes second nature, right? You want to practice this either in your demo account or maybe on a Saturday when the market's closed. Go back and back test your strategy from 1 or 2 strategies that you've chosen that you feel comfortable with. Go back to a chart and back test your strategy. See the different entry opportunities based on your checklist. Right? And the more you do this, you're going to build a familiarity with the strategy. You're going to become more effective at spotting entries, and that way you don't have to think about it when you see it occur in the live market. I've seen this before. I know what the market should do. That's what technical analysis is. It's pattern recognition. Right? So the more you see something occur, the more likely it's going to happen when you see it again. That's how the market operates. Once you have achieved mastery of a strategy where you don't have to think about, well, what if the market does this? What do I do then? What if the market unexpectedly retraces? Is it getting ready to reverse? Is it just pulling back to a deeper C? If you know the answers to these questions without having to sit there and try to recall the information, I just don't remember, then if that's the case, if you don't really remember, then continue to polish your skill set on that strategy. If you, without having to think about it, know what the market should do next, if the market does A, then I'm going to do B, etc., etc., then at that point, you can look to increase your knowledge base, increase your repertoire of trading moves, right? You can look to identify a new strategy that you may perhaps want to trade, etc., etc. Now, when it comes to your trading, we don't want to remain static, right? We want to continue to experience financial growth. So we want to put in a plan as well to be able to grow financially. Initially, when you get started trading the Forex market, it can be a little difficult, right? Especially if you're looking at multiple currency pairs. Some traders just choose a few, 5 or 6, right? That's the maximum that they end up looking at, and that's it. If they don't find any entry opportunity on those currencies, then they're done. For me, as an analyst, I have to be able to present information to you in a timely manner. So I have to do the analysis on all the pairs and multiple time frames and have all this information ready so that when you guys ask me, yes, well, this currency is doing X, Y, Z, blah, 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 right? I have to do that. But for the normal trader, the typical trader, there's no obligation to look at multitudes of charts. You can just choose a few that you feel comfortable with, and that's that. Just do your analysis on those charts. The initial analysis step may take a while, right, getting all the way to current, but from then on, it's just slight maintenance whenever the market makes a change or fulfills an ABCD. And if you're using the auto fibs, you don't even have to do that because it'll do it for you, right? So it's just slight maintenance as a normal trader once you get going. And to find an entry opportunity, the workload never really increases, but if we put in an appropriate, getting started kind of sucks, but once you have your charts up to current, then that's it. Your workload doesn't increase any more than that. You're just looking for an opportunity, and it's not that difficult, right? We just follow the rules. The strategies have already been planned out for us. So we just follow the rules, looking for an entry opportunity based on those rules, and we get in and we get out, okay? So if we decide to get started, let's say that I just got started, I opened up my new account, and I'm decided I can comfortably trade with a mini lot and not blow out massive chunks of my account if this were to go wrong. All right? So if I decided I'm going to start trading with a mini lot, then I'm going to put in a trade plan. And the trade plan should go as follows. Number one, I'm going to set an appropriate goal for myself, an attainable goal for the month, let's say. So for this month, I've set myself the attainable goal of trying to capture 200 pips, which means that every week I want to try to close out the week with 50 pips. All right? If I can achieve this, by the end of the month, I capture my 200 pips, what I'm going to do is next month, I'm going to jump to 2 mini lots. And I'm going to try to capture the same 200 pips. Or I may choose to increase my goal a little bit. If I manage to reach the goal again, then the month after that, I'm going to increase my lot size to 3 and then to 4. If I manage to not achieve my goal, I'm going to stay where I'm at until I manage to achieve my goal. If I achieve my goal, then I will progress. Again, the workload does not change, but the payout does. All right? As my account size continues to grow, I can continue to take on bigger lot sizes, and before you know it, you're in a position trading with a standard lot, you capture 10 pips, and now you're out of the market with $100. Right? Just, you know what, that's enough. I was in this position for 15 minutes, I'm done. Close. Okay? Figure of speech. But before you know it, you're able to take in smaller positions, doing a lot less work, not even being in the market for that long, capturing significant amounts of profit without having to even break a sweat, right? But you have to put in the work. You have to take the time, right? Everyone has different starting points. So if your starting point is a little bit behind someone that you know, again, that's not really something you should be concerned about. This is a one-person sport. This is about you and your trading. So this is not a competition. Do what is within your grasp. Take the trades that are appropriate and that you have qualified to be appropriate based on the rules. One thing you don't want to do is you don't want to be jumping around with lot sizes. Okay, you do not want to be jumping around with lot sizes. So if you started today with a mini lot, 5 months from now you're up to 6 mini lots,
and then you feel that you've been trading long enough, you feel you've got this market figured out, and you say, you know what, I'm done. I'm not doing this anymore. I'm just going to kick this right up to the standard lot. I'm doing it. All right? And you figure you spot the trade of a lifetime coming up, you're going for it. You're going for the standard lot. You're going for multiple standard lots. Who cares? Because this is going to work out. It has to work out. It's guaranteed to work out. And that's when you take the loss. And you have your account, or you blow out your account completely. Right? This is what we're trying to avoid. You take a one big hit, now your account is a fraction of what it was before, and now you're scared. Right? Now you don't want to take any more trades, or now you go back to trading 1 mini lot. Right? The issue with this is, number one, you kind of put yourself in that position, which sucks, but you don't need to hear that. Number two, since you're now going back to trading a smaller lot size, it's going to take you a very, very long time just to recuperate what you lost. Never mind to be able to once again start growing your account. So it's best that we don't do that. Be consistent as you increase your lot sizes. If you manage to hit your goal, then increase. If you don't hit your goal, then remain where you are. Do not go backwards. All right. Any questions on this before we conclude this equity management webinar? Any questions on this? All right, perfect. So traders, we're going to go ahead. We're going to adjourn this discussion. We're going to come back in at 10:30 p.m. Excuse me. We're going to come back at 10:30 p.m. for the first education discussion on the road to be able to trade non-farm payroll. So I'll see you all back here at 10:30 p.m. with the support and resistance discussion that we're going to have when we return. This has been Will Gomez, FX Showtime.